So let's see. Let's start the lesson. So this is the series 3, course on finance for undergrads. For Huachao University International School, where you're gonna learn some basic concepts of finance, and then when you will go out, based on your knowledge on economic skills or econometric skill and statistical skills, you will better make a sound evaluation or judgment regarding financial issues and problems. So what did we do last week? Last week we started with the reasoning and features of financial and economic crisis, right? Uh, okay. So last week we started with the main features of financial and economic crisis in depth. The main cause was lack of liquidity because of decline in the prices mostly. So whenever we figured that mostly the financial crises are backed by the prices volatility or uncertainty in the prices certainly of any sector, and then it's spread out in different sectors, which is for sure triggered by the bad policies of regulatory bodies, right? So decline is in prices are there, but mainly because of the bad policies. Oops. So bad policies triggers the decline in price, and which can cause depression in specific sector. Besides such, who can make the financial policies or bad means any kind of policies? Mostly the government institutions like Ministry of Finance, Ministry of Economics, or Commerce Division, or Central Bank. So that's how the bad qualities triggered out. Later, the crisis in one sector of an economy got a multiplier effect. Now, what is multiplier effect? Why it's not working in such a way? So what's the multiplier effect? It's very simple. Like you are my class, and you are friends to each other, right? So if because of me one student got affected, and that student affects another student, and that student affects another student, so that's how the same effect will be multiplied to the number by the number of students, and it gives me a big amount of the impact. Another example, let's say your home example, like you are stressed, for example, okay, just as an example. It's not that you are stressed. I know you are always jolly person. Yeah, you're always jolly people. So you're enjoying every moment. So, but for instance, for this example, to understand this, let's say you are stressed, you're having a stress. Now, your stress also impact your family members, like your parents, right? Like your grandparents. And because of your stress, they get into stress. Now, if we consider the whole stress of the house, now your stress becomes twice, double, because your stress will be added into your parents' stress, and your parents' stress then added to your grandparents' stress. Do you understand this? So that's how it gets a multiplier effect. Let's take a simple example. We know the relationship between interest rate and investment. If the interest rate becomes high, there will be a less investment. You will not invest because the bank will give you more money than the market. Simple, right? Let's say if you invest the money in the market, I will keep switching the screen sharing. So let's say you have invested the money in the market and the market gives you 10% return after some time. Now, if there is a high interest rate, interest rate is 15%. So a bank or any other financial institution, they offer you that if you give us the money, we will give you 15% of the profit. I mean, of the money you will invest in us. You will think that in market, if I go and invest, I will get like only 10%. If I in a bank, I will get like 15%. So you will not invest in the market. What will you do? You will buy the securities, bank securities, or you will buy the debt securities, or you will just simply deposit it, right? So that means if there is an increase in interest rate, it will decline investment. That's one relation of interest rate with investment. Then we have another relation. We know economic growth, right? Just for your understanding, economic growth. We know that if there is an increase in investment, it will decline it will increase in economic growth. Then we have another relation. We found that in literature, that if there is an increase in interest rate itself, let's say IR is the interest rate, this will decline the economic growth. And let's say, for example, if we increase in interest rate, it also decline exports, because there is no investment, less investment, so there is less production. So if there is less production, there will be less export. Do you understand this? So now one relation is this one. That's a single relation, single impact of interest rate on economic growth. Then one relation of interest rate on economic growth is through investment, right? So investment, this if impact will become double, right? And then one impact comes from the export side, and then it becomes 3 times. So one, if you impact by yourself to another person, that's one. For example, you are 5 friends, and let's take a real life example. You are 5 friends, and somehow 2 friends, they fight each other, right? So they don't talk to each other. Now remaining 3 friends, they are in trouble, right? So they will think that who to give support, their support. So one of you say to other friends that if you're gonna talk with him, I'm not gonna talk to you. See, that happens. Sometimes that happens. So another friend is not gonna talk to me. So now 2 friends, they don't talk to me. Then those 2 will tell the third one that if you talk to buddy, we are not gonna talk to you. So you can choose either to talk with him or to talk with me, us. So he will decide, he will say, okay, I'm not going to talk with him. So that's how you four can isolate me. So before it was only 1% impact. I had a fight with 1%. Now four people, three more people, they get to his side or her side, and now I lost my friendship with my friends. So that's the multiplier impact. Usually we see the multiplier impact in cases of interest rate, in cases of inflation, in cases of investments. We see the multiplier effects, especially in regarding with the returns. So that's the multiplier effect. Now, so later on, the crisis impact, it becomes multiplier impact. It first happens in one sector, then one sector impact another sector, and both sector together impact the economy. Then those two sectors impact the third sector in terms of job loss and other stuff, and that's how it's spread out over the whole economy from one sector. And because of one policy, one bad policy impact the one sector, so it's just like a disease in the body. um, so that's what we talked about. So if I share the screen now. So what will be the reason? So if in the start the problem is not solved and it is not bailed out, for example, we saw that 2008 2009 crisis happened due to the house sector or homes house construction sector, right? So if in the start the government should help could have helped the construction sector, but they didn't. So you need to bail out. So that's the first thing. First thing, you analyze that where the problem lies, and then you try to bail out. Bail out means you give some fundings through the central government to help that sector to stand on their feet and to run normally. So if it is not being bailed out, it spreads the whole region, and from whole region it can go on to the whole world. But remember, the intensity will be different. So intensity means severity of the crisis will be different. It will be higher at industry level, and then it becomes mild at a country level, then it becomes further mild, like not that high intensity at a regional level, and then so on. So it should be handled well to not to spread at a global level. You can take an example, because it spread just like a virus, right? So virus happened to be in one person, then it spread in the whole community, then it spread in a society, then it spread in a province, then country, then internationally, and that's how it works. Same thing happens here. So there is no absolute profit in the world. Remember that. And equation is balance. Although there is a relative profit, does exist. As if someone is having a profit, let me show you. So there is no absolute profit. Absolute profit means you cannot say that I earned this much from somewhere, because the profit doesn't come from the sky. Yeah, you need to earn it, and the equation is balance. Why? Because the resources are balanced in the world, so we always need to manage it, we always need to handle it well. The person who can manage the resources well, he can or she can earn a lot of profit. But remember one thing, profit is always in relative terms. Overall, let's say you are in China and you invested in some stock and you got $100 profit. But you got $100 profit, extra $100. But somewhere in this world, I think the accounting students will understand this well. Somehow in this world, someone or maybe more than one people, they are having losses, they are facing losses, and maybe they'll, if we put together their losses, you can say one person getting $10 loss, another person getting $30 loss, and another person getting $60 loss. So someone is together or single handedly is facing the loss of $100. That's the real thing. So profit to one person is definitely because of the someone somewhere in the market which is associated not directly but indirectly, he or she is facing the loss. So overall, we can say that in absolute term, there is no profit, no loss. But in relative terms, there are profit because we don't know who got the loss at that moment. So relatively, we say that, okay, I'm better off than rest of the people. So that's also the reason. That's the reason that certain economists or financial experts, let me share the screen. So that's also the reason that economists, they are always busy in finding the new resources and it's their utilizing the utilization. Because if you find new resource first, then you're gonna have profit first, right? And then rest of the people may have to face loss. Anyway, we learned all about this, that the central philosophy of any crisis is the bad policy, which originates further economic issue, and then that economic issue extend to the sector, and only way to solve it is to give the bailout program to the affected industry. What is bailout? I tell you again. Like, let's say you are familiar with the COVID-19 disease, which spread in this region, in this globe recently from last year, late last year. So most of the countries, they couldn't face the financial loss. Most of the country, they couldn't face the financial loss because of the COVID-19. So the rich countries or the developed countries, you can say IMF mainly, because IMF the one who can help, who can bail out certain countries. So what did they do? They provided the bailout packages to certain countries who couldn't afford to solve this issue. So you see, financial institutions help has a really important and major role in different sector of the society and at different times. Another thing, like, let's say most of the people, they have put lockdown situation. I'm explaining these concepts to you because these are the real life concept, and you should know the application of the finance, not only just memorizing the definitions and concept of the finance. You should know that in real life how it works. Most of the countries, they have lockdown situation. In China as well, in first 3 months, uh, from November, I think from this January, yeah, from January or December, something like that. Even the places where the virus was not spread, they had the lockdown. Even now, it's like slowly reopening. That's one reason that I am still here and I couldn't go, I couldn't reach out to you, and I'm just using this medium of IT in order to convey or in order to share what I know. So what I'm telling you is that when lockdown happened, many people lost their jobs. Most of the people, for short time, even for short time. And some people, if they lost their job for a long time. In China, it didn't because China managed well. So that's what I'm telling you. So to by resourcing, because China invested a lot in managing COVID-19 spread. What did it? What did China do? Then I will tell you the example of another country. What did China do? China just locked down everyone who is there. There, you cannot move into different provinces. You cannot travel. Everything is banned. Even from the community, you cannot go out for a certain time period. So it means you're not gonna go for work, and suddenly in the start everybody has to bear the losses. But Chinese government, they compensated those losses through different packages. Now those packages are known as bailout packages. China has enough funds, enough resources, enough reserve funds that they bailed out their own industries, different industry. They bailed out their travel industry, like airline industry, and similarly many other financial institutions. They bailed out their financial institution, even they bailed out their stock exchange. So because of the resources. On the other hand side, we can say equally large country as China, which is India. So in India, almost 2.5 million people, they lost their jobs in a first phase of lockdown, because they put the lockdown because there is no other solution at the moment, other than lockdown. So they have to lock down because they don't have any other solution. The vaccine is not isn't still is not available. So they locked down, but that impacted their labor market. So their daily wages labor, who are working on the daily wages, they they just suddenly drop down, they suddenly increase the poverty line in India. And since they didn't have enough money, so they didn't provide enough money to different sectors. Also, different sectors, they didn't hire, or they just fired the staff, which is useless. And for that instance, then IMF jumped in, International Monetary Fund, and IMF just issued some loans, some bailout packages for the countries like India. So that's the bailout. So you need to understand what is bailout when I say bailout. So bailout, you can solve the financial crisis in early stage if you can have money, or if you can lend money from another country and try to help your industry so that doesn't spread outside. So that's the only solution you can have to make yourself safe from the impact of financial crisis. When I say you, it doesn't mean you personally, it means like your economy. So we learned basically about these things. Then we learned the transformation of saving to investment in monetary system, following the features. Oh yeah, that how the transformation happens from saving to investment, how the savers become investor, mainly through monetary system, following the feature of monetary system like money supply and investment banks, depository banks, or institutions. Then we talked about the role of central bank. Then if you remember properly, we learned the difference between real and financial assets. So different features of money we talked about, that with its defining phenomena like medium of exchange, store of values, purchasing power parity. What is purchasing power parity? You know that, right? Do you know that what is purchasing power parity, or what is purchasing power? Yeah, it is. I think we have covered this. I'm talking about purchasing power. So purchasing power means in 1 RMB, how much things you can buy. Let's say today in 1 RMB, you can buy, what can you buy in 1 RMB, by the way? Maybe you can buy a candy, one candy for 1 RMB, right? Just an example. So 20 years ago, For 1 RMB, you could have bought maybe 10 candies. So that's the purchasing power of RMB. Similarly, we can say $1. Today, you can buy like a cup of coffee for $1, but you cannot buy a cup of coffee for 1 RMB. So it means that the purchasing power of dollar is higher than the purchasing power of RMB. So that's the purchasing power. So we talked about different concepts. First, it is used as a exchanging good for good. That's barter. Then purchasing power. What is inflation? Inflation means increase in the value of money over the time. So this purchasing power decline is also between these years is also because of the inflation. So there was an inflation of 9 candies. So prices of 9 candies got increased over the time. Then we talked about the liquidity and this different concept and credit worthiness. That, for example, if you go in the markets and or if you ask your friends around you in the class. Now, in the class, there are almost like 60 or 70 students, right? So if I ask one of you to ask money from, just example, okay? No, don't ask money. To ask you to collect the charity. Charity means to gather the money for a good cause. So if I ask one of you to collect the charity, and okay, let's say, let me tell you in detail that what does that mean. So let's say I I pick 4 students from this class of 68, right? And I give them task. Then you have to collect money from the rest of the class as a charity. As a charity, because we're gonna help some poor people. First, one person goes, and from 68 student, he could have like gathered maybe 100 RMB. Just example, right? Another student, he could have got like maybe 2000 RMB, and another student, he got like 1500 RMB, and another student, he got nothing. Let's say 1000. So, who it means that the student B, A, B, C, D. The student B has higher credit worthiness. So people can give him more money because they trust him. They think that that person never gonna lie. He doesn't have any moral hazards. So we trust in him. He has a good credit value. Uh, Means he wouldn't be cheating on us. So that's the credit worthiness. So we talked about the credit worthiness mainly about the firms, because whenever you are going to get a loan from an individual, from a bank, they see your credit worthiness, even your friends. So let's say there are 2 friends, again A and B, and A asks money from the friend C, but friend C knows that A doesn't have a job, so probably he won't give him money because he knows that how can he A return the money, because A doesn't have a job, A doesn't have a house, so it's not possible that A will give him money. So probably he won't lend him money. But B is having certain amount of money every month. So C will not think secondly, he will be both are his friend, but C will give money to B because he knows that after 1 month he will get the money and there are chances that he will return the money back. So that's the credit worthiness. So it means your work, your knowledge, your job, they all make your credit score and credit worthiness. That's how well. So we talked about different in the companies that they make like rating for other firms. Oh, maybe you cannot see. Yeah, for other firms that how much money you should lend to them. So that's about the credit worthiness. We talked about this all. Then, if you remember properly, we talked about difference between real and financial assets. Real means physical assets, right? And financial means assets in terms of finances. We also talked about the money, what different kind of money, uh, oh, the development stages. We talked about the development stages of coin money and paper money, how they happen to develop over the time in US, leading to the credit money and ATS and debit cards. So now there is a new concept of bitcoins as well, which we may cover later on if we have time. By the end of this semester, I will arrange a special uh, I had a I had a I have a very good friend. Let me tell you about this thing. So that you should know that how does it function at this stage. I have a very good friend, and he is like a consultant about the bitcoins. He's I think from yeah he's Bulgarian. So but he has been working in bitcoins over the long time, and he has done his studies from Oxford University in finance. So I will request him to give you like 30 minutes or maybe 1 hour session on Bitcoins, but not promising you. But at the end of the semester, we will try to arrange, and I will ask him to give some time on the to explain you the main concept of Bitcoins. Okay, so but for now, we're gonna skip the Bitcoins. Uh, it's like a more kind of a digital kind of a money, and numbers are there. So today what we were going to learn. So today we will talk about money market securities in details. You already know about the money market security and how to measure I'm sorry, yeah, how to measure the money supply and its role in making economic activities. We will also look into international monetary system and its application to economics and finance. In last session, we will learn about the types and role of financial institution if we will have enough time. But probably we won't be having enough time, so we will do this in next session, specifically in a historic perspective during the crisis, and then we will learn in details about the depository institution, uh, contractual saving organization, how do they work, what is the framework, what are the security firms, what are the finance firms, what do they do in the market, and why do we need them. We're gonna talk all about these things, and we're gonna know that how what is the function of these things, these topics. So let's start with the money market securities. We already learned that what is security. So can you tell me what is security? Hmm? Can you tell me what is security? No, nobody answered me so far. Oh yeah, oh yeah, somebody answered me. Let me see. Oh no, it's from somewhere else, right? Not from you. Oh yeah. Oh, so okay, you are in this group. Just join this finance group because we are together. Yeah, security. Yeah, that's right. Uh, Shu. Shu. Yes, you're right, and I'm really glad that you know that what is security. Basically, security is the promise. What kind of promise? To make you secure, to make your investment secure, right? The money's and so what is it? Sorry, where was I? Yeah, we were talking about the money system and its application to economics and finance. So market security is a debt promise, means is a promise about the debt and security with the short term. Now promises are meant to be fulfillment, right? If the promises are not fulfilled, people they don't trust on each other. So security is basically to a secure promise that it should be fulfilled. And who's gonna monitor this? Financial institution and central bank and the government, all these regulatory bodies, they're gonna monitor that your promise is secure or not if you are issuing a security. So we can conclude that promises are meant to be fulfilled. If we can say now that money market security is a debt security, we can say that, right? With the short term maturity. So money market security, oh, why it's always this. So money market security is short term. Remember that. It's not a long term. It's a short term promise. It's a short term security. So short term, we know that it should be less than equal to 1 year. So from 1 minute to less than equal to 1 year, that's short term. Now, what can be the claim in such a promise? Can you tell me? So claim is the stock of money market security. Is stock a money market security? Can you tell me that? Stock, like in stock exchange. Is stock of any company a money market security? Is it a security? Let me see if someone is answering or not. Investment instrument other than, okay, that's right. But like, tell me, is stock a money market security? I will say no, it isn't. Why? Because of the time. And the time is more than a year and it's tradable. So what are the securities with less time? Means less than a year. What kind of those securities? So those securities mostly includes T-bills, or we can call it Treasury bills. Um, we can call it wow, why it's like this? T-bills. Mostly T-bills means all the T. What is T-bills? It is issued by the central government. It's mainly the concept started from the US, but it's not limited only to US. Many countries had adopted this system of issuing. Okay, so yeah, so it is mainly issued by the central government. In US, it is issued by Fed. That's the Federal Reserve Bank of US. But most, as I told you, mostly in many countries they issue T-bills, especially those countries who couldn't face their finances. So the maturity time is from 3 months to 1 year. That's a very common maturity time, 3 months. But it can be up to 6 months. So there can be three categories of T-bills. That's 3 months T-bills, 6 months T-bills, and 9 months T-bills. These are usually issued by the central government. In US case, it's like US government means Fed, as I told you, and anybody can buy it. Anybody can invest in this. Investor can be you, me, any firm, or any institution. So it means it's open for any kind of investor. Um, then we come to the commercial paper. What is commercial paper? It's a short-term unsecured promise, right? It's a short-term unsecured promise. So it means its maturity time is less than 1 year as well, because all the money markets is maturity time is less than 1 year. That's we know by definition. Now, what's the difference? Why do we have commercial? So one thing, remember one thing. T-bills is highly trustable and it has a high frequency of trading in secondary market. So it's really highly tradable product. So I missed the tradable here in secondary market. Means if someone has T-bills, it can easily be traded in the secondary market. Nobody has a doubt. But commercial paper, that's moderately in tradable in secondary market, because it's an unsecured promissory note. So unsecured promissory note means me and you cannot invest or buy that. Only the financial companies, the business firms or institutions can buy them. Why? Let's talk about this later, but it is also issued by the business firms and institutions, remember. Now we see that why it is only invested and issued by the business firms and institutions. Mainly because of the liquidity problem. So companies and institutions can only take part, and its maturity starts from 1 day to 9 months. It is just like a bond, but issued by a high rated institution and companies. So high rated, this is not by government, but these companies and institutions are really high rated, means they have a really high credit worthiness, and it is meant to buy only by the business firm. Normal people cannot buy it because of some legalities. We couldn't have those kind of premises. We can only invest in T-bills. Remember, rest are all about the business firms. So commercial paper is used, but it's not that used. It's not that commonly used. But still, you can means high firms can issue the commercial paper. Then there is a negotiable certificates of deposits. Now we see the word deposits, right? So it means it is by the banks, by the depository institutions, not by anyone else. So only depository institution can issue the negotiable certificates. It's up to 1 year and it is invested by business firms. What is this? Its trading is really low. It's not highly tradable or even moderately tradable in secondary market. You know the secondary market, right? And it's up to 1 year. Usually, it's rare to invest in that. The issuer is depository institution where firms are investors. It can also be traded in security market, but with a very low rate. Then comes, okay, well, we have time or not? Yeah, we have a couple of minutes. So let me tell you one thing. Oops, I didn't have a camera. So the problem with the negotiable certificates, that because it is only issued by the depository banks or depository financial institutions, so that's why it's only meant for a short time to make sure that the company, the firm, can get the benefit. Firm can invest in the depository institution so that the depository institution can be can solve its temporary liquidity problems. Because sometimes let's say I have a depository institution and I am lacking of some liquidity. So what I will do, I cannot issue bonds, I cannot issue T-bills, I cannot issue. The best way for me is to just issue a certificates that you should give me money and I give you the certificate. It's also promissory, and after like maturity, which is less than 1 year, I will give it back to you. And for time being, I will have enough finance to make my functions properly running. There are more tools, more certificates, more short-term instruments in money market, which we're gonna talk after like 10 minutes break. Okay, so let's meet at 3:30 again, and then we will have a session of around 40 minutes, and then we have 20 minutes break almost, and then we will have a session of 1 hour. So until then, if you have question, I'm gonna unmute you and I'm gonna stop this part 1.